With so many different markets and states and capital cities and regional areas and suburbs in Australia, it can be really, really, really overwhelming to find the right suburb to invest in for your next property or to buy for your own home. So in this video, I'm going to explain exactly how you can narrow it down from the literally thousands and thousands of options around Australia and find the exact suburb that's not just going to get great outcomes today in the short term, but great outcomes in the long term as well. Now, before I start looking at actual suburbs or actual properties within suburbs, the very first thing I do is I have a look at the CoreLogic monthly update. Now, that gives me a really good understanding of what's going on across the different capital cities as well as major states in Australia. And then I have a look at Heron Todd White's month in review report. Now, the reason I start at a higher level is because before I choose a suburb to invest in, I really want to know where the different markets are at in Australia in terms of their overarching timing, so that I'm not, for example, buying a market that's at the complete top of its growth cycle, which means I'm not going to get any meaningful growth for the next few years. But I also don't want to buy a market that's in the declining phase at the moment. So between the CoreLogic update and the Heron Todd White month in review report, you should get a really decent understanding of what's going on in the Australian market. And then from there, your goal is to reduce it down to one state and then one market. Now, when I'm investing in property personally, I'm generally looking to target the major metro markets. Now, CoreLogic or RP Data did a really, really decent report where they looked at 25 years worth of data in Australia's 7 metro markets or capital cities versus Australia's 7 largest regional markets. And what they found is that over 25 years, the metro markets, which are the Sydneys, the Melbournes, the Brisbanes, the Perths, performed about 96% better over 25 years. Now, that is a huge amount of money to leave on the table, almost 100% growth over 25 years if I'm looking outside of those markets on average. Now, some regional markets have absolutely kicked ass as well in the last 25 years. I think Byron Bay, for example, has been Australia's #1 performing area over that 20-year period, but when we're talking averages, that's what I'm saying here. So I like to buy in the major metro markets, or if I'm not buying in the metro market, I like to buy in the major regional markets connected to the metro. So if you're thinking Melbourne, for example, maybe we're talking Geelong, Bendigo, Ballarat. If you're talking Sydney, then maybe we're talking Central Coast, Newcastle, Wollongong. If you're talking Brisbane, then it might be worthwhile having a look at the Gold Coast, North Brisbane, and the Sunshine Coast as well. So, the reason I like those areas is because that's where the population growth is flowing, that's where the jobs are, that's where the higher incomes are, that's where the major infrastructure projects are, and they're the areas that are going to continue to grow, not just in value, but in terms of population and income and housing over the next 20 years in Australia. And it's pretty clear that those areas are going to capture the lion's share. I think Michael Matusik said that 25% of Australia's population, job and infrastructure growth in the next 10 years will go into southeast Queensland, 10 or 25% will go into Sydney, and 25% will go into Melbourne. So I don't like rolling the odds against the house, and I like to invest in the areas where I can guarantee good long-term future potential. So once you've reduced it down to a state, for example, Queensland, and then a market within that state, I think Brisbane, according to the Heron Todd White report, looks really, really interesting at the moment. According to the latest CoreLogic update, it's actually cheaper in 2019 to buy Brisbane when you factor in inflation than it was in 2008. That means it's been flat for 11 years. And if you know your history, you know that markets don't sit for flat for much longer than about 10 to 12 years based on what you can look at in Australia over the last 50 years. So, let's say we've reduced it to Queensland, then we've reduced it down to Brisbane. Now, to get to the suburb level, there's one more thing we need to do. Now, if you're in Sydney, for example, Sydney is a huge area with so many suburbs, but within Sydney, there are major regions. So there's the Northern Beaches, the Southern Beaches or the Sutherland Shire, there's the Inner West, Inner North, there is the city centre, and then there's all of Western Sydney on top of that. Now, these are different markets within a market. It's the same thing within Melbourne, it's the same thing within Brisbane. And anybody that lives in these markets knows that there's certain areas that have higher incomes, that have higher percentages of owner-occupiers, that have different demographics. So I don't just want to buy the right city at the right time in the right state. I also want to be buying the right pocket. Now, the cool thing about Brisbane right now, for example, is it's kind of like buying in Sydney or Melbourne 20 years ago. And so 20 years from today, Brisbane's going to look a lot more like Sydney and Melbourne than it does like Brisbane right now. So if you think about traveling back in time and going, if I could have afforded to buy anything I wanted for $400,000 or $500,000 in Sydney or Melbourne 20 years ago, what would I have bought? Now, because you don't need a crystal ball to look at that, you can go, well, the eastern beaches of Melbourne, the Mornington Peninsula, and parts of the city centre, or within that 7-kilometre catchment of the city centre, have absolutely hammered the performance of, for example, West Melbourne or North Melbourne. And you can look at Sydney and look at the same thing, you know, the eastern beaches, northern beaches, and southern beaches, as well as pockets of that, 7k radius from the city, have absolutely smashed the performance of Western Sydney, for example. So Brisbane is no different. And the way that I like to describe Brisbane right now is avoid the south side of Brisbane, avoid the western side, only because the demographics look a lot like the demographics did in Western Sydney or northern Melbourne sort of 20 years ago. There's a lot lower incomes down there. There's a lot more investors buying down there. The jobs that are being created down there are much lower paying jobs. There's a lot of housing commission down there. There's a lot of people on welfare down there. And those aren't the types of fundamentals that if you've got a crystal ball and can look 20 years into the future, that you want to miss. Now, an example of this is 20 years ago, you could have bought in North Melbourne, for example, and you might have had to pay at that time, $300,000, maybe $200,000 to buy the home that you wanted to buy. Today, that same home is now worth $500,000, for example. But at the same time, you could have maybe spent a little bit more money buying a slightly higher quality area, something down on the eastern side of Melbourne for maybe $450,000 at that time. And that same property today would now be worth $1.5 to $2 million. So just because a city is increasing in value doesn't mean that all of the areas or all of the suburbs increase at the same rate. So, I like North Brisbane personally and East Brisbane. My preference in Sydney is definitely the northern beaches, eastern beaches, or southern beaches. And in Melbourne, it's definitely the eastern side of Melbourne if I can afford to be there. So, again, not everyone has that option, and I completely understand that. But if you're looking at the best suburbs in Australia, and you may as well be investing in the areas that get the strongest long-term potential for growth. Now, let's say that I've now reduced it to, an area in Brisbane. I've reduced it to the northern pocket of Brisbane. Now I start to overlay the things that are important to me in terms of my strategy. Now, when I'm investing in property, I'm looking at a number of things. I'm looking to buy as close to the city as I can afford, because the Michael Matusik's research has shown in every metro market in Australia that houses within 20 k's of the city perform better, or houses on the beach perform better, walking distance to the water, and that's a no-brainer. You've seen that in Sydney, Melbourne, Perth, Brisbane, time and time again over the last 100 years. So I like to buy houses. I like to buy nice big blocks of land. I like to buy the quality pockets of a suburb. Again, you can go buy the cheapest house in the cheapest street, in the cheapest pocket of a suburb, but over time, history has shown us that the quality pockets where the owner-occupiers lives with the nicer blocks of land and the nicer homes all cluster together, and those areas increase in value faster. And you can see that in Sydney, and you can also see that in Melbourne, because they're 20 years into the future. So I've reduced it to northern Brisbane, for example. And then from there, I go, well, there's a hell of a lot of suburbs in northern Brisbane or northern Sydney or northern Melbourne. And what I start to do from that point is I start to look at the key performance indicators that help me decide if a suburb is worth looking at or not. Now, there's quite a list of these types of things, but some of the ones that I look at are, for example, 10-year growth rates, 3-year growth rates, 12-month growth rates. You can get all of that information for free online just by Googling it. I also look at things like average vendor discount in the suburb, number of days on market in the suburb, average price point, the DSR score, which is the demand to supply ratio score, and a really good indicator for understanding how hot or cold a market is right now. I look at auction clearance rates in the area. I look at average rental returns in the area, because my strategy isn't just buying the right market at the right time and the right position, but it's also about getting good long-term potential for capital growth, really good potential for good rent returns. And I like dual income properties personally, so I make sure that I'm targeting suburbs or areas of a state or a city that actually allow me to do that, like a house and a granny flat, for example. I also like properties that I can add a bit of value to through like a renovation or cleaning them up in the future as well. So I've got these little things that help me inform my strategy, which makes selecting the right suburb better. Now, once you've gone through those high level indicators, like what the average household income is, how many people own in the suburb, how many people in the suburb rent, the quality of the schools in the area, the quality of the infrastructure like train stations, shopping centres, access to education, access to beaches, how long it takes to get to the city. What you've done is, like, you may have had a catchment of North Brisbane, but after looking at those indicators and comparing one apple or one suburb versus another, all of a sudden there might have been 20 suburbs within 20 k's of the city of Brisbane. And after going through those indicators, there's actually only 3 or 4 which really make sense to you based on what you're looking for. Now, I want suburbs where there's a very high percentage of owner-occupiers, because emotional people that live in their houses for a long time spend their excess money cleaning up their houses, and so those suburbs improve faster. I also want suburbs with very low rental vacancy rates, so that when I invest in that suburb, I can get a tenant without too many dramas or too many issues. Now, you've reduced it down to 3 or 4 suburbs, then now's the time to sort of get onto Google Maps and get on realestate.com. And what I do there is, on Google Maps, I look at the suburb and I start mapping using the data from realestate.com in the sold section to actually cluster the quality pockets. So what I mean by that is, in every suburb there's cheap sales, there's the average price sales, and then there's the expensive ones. So what I do is I get a pen and I print out on Google Maps a little suburb, like a little picture of the suburb, for example, and then I go on realestate.com and I look at every house that's been sold in the last 12 months and I start mapping it out. Now, I put all of the cheap properties that have sold in red, I put all of the more expensive properties that have sold in blue, and I put all of the ones in the middle in green. And that helps me get a much better understanding of the good pockets and the shitty pockets of a suburb, or the cheap pockets and the expensive. And then I start looking at what I could afford to buy in the green or blue pockets, because I want to be owning the best quality property in the best quality pocket of the suburb. And then from there, if I'm in the area or if I make the time to go see the area, what I'll do is I'll jump in the car and I'll drive around those 3 or 4 suburbs and I'll have a look at some of the properties that have sold, and I'll really start to get my head around it. So all of this activity that you're doing is basically helping you reduce your decision down to one suburb, because if you're looking at any more than one suburb at a time, then I or someone else who knows the suburb better than you has a buying advantage. Now, all of this stuff is for you, for someone who hasn't really identified which suburb that they're buying in. Like, if you're just buying the suburb close to home because that's what you know, then, you do what you know. But if you want to make the best possible investment decision, identifying where the Australian market's at, then which state represents best value right now, which capital city, which pocket of the city, which suburbs within that pocket, and then which properties within that suburb is the right way to go around getting the best possible outcome. Now, I'll give you an example of why this is so important to me. if you were to go and buy your average property in your average position, in your average suburb, in your average market, and get a 4% return, let's say you spent, $400,000 to go and buy that property. Now, because you didn't do any of the things that I've mentioned in this video, you just got a 4% return on your money, or 4% capital growth on the property on average per year over the next 15 years. Now, let's say that I did all of those things that I just mentioned. I used timing, I got outside of my comfort zone, I found the right area, I found the right state, and I got a 6% return, which is certainly achievable if you're buying the right property over the next 15 years. The difference between you spending the $400,000 and getting 4% return and me spending the same $400,000 but getting a better area at the right time is going to be about an extra $235,000 in growth that I make just from getting that extra 2% gain per annum over the next 15 years. Now, that one decision for me to spend a little bit of extra time, maybe an extra 5 or 6 hours than you did, identifying the right area before I start looking at houses, has made me $200,000 plus. It's pretty good return on time, you know what I mean? Like, that's $40,000 an hour. Pretty good return on your time. So let's say that you're looking for something a bit more expensive than that. You're going to spend $1 million, and instead of doing the things we've talked about in this video to help find the right suburb, you just go and do whatever you do, which is buy where you know at the wrong time, or buy close to home because it's easier and you understand it, and you get 4% return on that $1 million per year over 15 years. But I do all the things in this video again, and I get a 6% return on that $1 million over the next 15 years per annum. The difference in that one decision, again, it's probably an extra 5 hours of desktop research if you know what you're doing, or maybe 20 hours if you don't and you're just trying to figure it out, is over $560,000. Now, let's say you spend 20 hours figuring out the right suburb to get that extra return over time. $560,000 better off I'll be by just taking my time and finding the right suburb. Now, this is why it absolutely kills me that people just buy close to home. They buy what they know without taking into account timing. They don't take into account where the market's at right now. They don't take into account that, Sydney or Melbourne or Brisbane or Perth aren't just one big city. They're actually a combination of really good or really shitty areas across the city. And then within those really good or really shitty areas are really good suburbs and pockets, or really shitty pockets and suburbs. So all of these things make sense. And if you're an investor like me that wants to get above average returns, that isn't just looking for your meat and potatoes property, but actually wants to set up financial freedom a lot sooner by getting a lot better returns, then these are the types of things that you can apply. Now, my name's Ben Everingham and I run Pumped on Property, and over the last 5 years we've bought over $350 million worth of property for our clients. So this isn't me just talking shit in the car on my way to work on my drive. This is the things that I have learned and that I follow day to day to help me and my clients buy properties. Now, I've personally bought 12 properties in the last 10 years, and I've made all of the mistakes from not doing this stuff up front when I select my suburb. And these days I'm much more diligent, because I don't want to leave that 500 grand on the table on my next $1 million purchase, or the 230 grand on the table for my next 400k purchase. So I hope you've got some value from this video. If you haven't already done so, please subscribe to the YouTube channel below. If you like this video and got some value, please like it. And if you've got some other things that I missed, because I've just scraped the surface in this video with selecting a suburb, there's literally about another 150 things that I do personally that help me make a better decision, or help my clients make a better decision. Put them in the comments section below so that other people like yourself can learn from your experiences, because I'm trying to create a community of people here that are learning together and growing together, not hating on each other or cutting each other down, but helping each other improve. So if you haven't already done so, please like us or follow us on Facebook and Instagram, Pumped on Property. Check out our podcast, The Pumped on Property Show, where I talk about a lot deeper stuff than this. And if you are seriously thinking about buying a property in the next year and have no idea which market, which suburb, let alone which property you're thinking about buying, and it's all just feeling overwhelming right now because you've got information overload or you're paralyzed through all of the information you've been consuming, then jump over to my website www.pumpedonproperty.com and book a free strategy session in, and it is completely complimentary. We will do our best to help you identify where you are, where you're looking to go, and what's holding you back. But we will also take the time to properly educate you on the market, point you in the direction of some great resources. So if you want to go and do it on your own, you can go out there with confidence, looking at the right things and smash it. Or if you want some support, we can talk about how we might be able to help as well. So I wish you all the best. Slow down to speed up is the absolute key in the current market right now. It's not about rushing out there and buying something if you don't know what you're doing, because you don't want to leave that $200,000 to $500,000 on the table and then realize, like I did 5 or 6 years later, what all of those initial purchases you made actually did to your long-term wealth position. So I wish you all the best. Good luck. Go find that amazing suburb, because there are absolutely amazing suburbs right now around Australia. You know, if you look at averages, in 2018, Sydney dropped by 10%, but some suburbs in Sydney went up by 10%. If you look in Melbourne, the average suburb dropped by 4 or 5% in 2018, but some suburbs went up by 10%. If you look in Brisbane, that did 0% growth in 2018, after 11 years of absolutely no growth on top of that, some suburbs that we bought in did 5%, other suburbs we bought in did 12 or 13%. So there is good buying despite where the media is at right now. And I believe within 2 years, a lot more Australians will be coming back into the market as we move through this stage of the cycle. And, you know, by that time, do you want to be paying more for the property that you can get today without as much competition? So good luck, go have some fun, get educated, and just realize that if I've been able to figure it out, you can definitely figure out, because there's nothing different between us, except I obsessed about one thing for 10 years, and I've had a lot of experiences in the space to help make those mistakes faster that normally take people a lifetime to figure out. So I wish you all the best. Go smash it. Good luck.